In this video, I want to talk about understanding sector funds. Sector funds, how to invest in a specific industries. Specific and sector-specific funds are investment funds that focus on a particular industry or a sector of the economy. These funds are designed to provide investors with targeted exposure to specific area of the market, allowing them to capitalize on sector specific trends and opportunities. So here is a detailed overview of sector specific funds. So these are the key concepts of this particular subject matter. Number one is definition and purpose. Definition and purpose. So sector-specific funds, what actually is the definition? And these funds invest primarily in stocks, they invest in bonds or other securities within a specific or a particular sector, such as technology, healthcare, energy, or finance. They aim to provide concentrated exposure to that sector's performance. And then the objective here has to do with the main objective or the main goal is to capitalize on the growth and opportunities within a specific sector while potentially outperforming broader market indices, that are more diversified. You aim to beat the index with sector-specific investments. Number two is types of sector-specific funds. Types of sector-specific funds. A typical example is sector ETFs, that's exchange-traded funds. These ETFs track the performance of a specific sector index. For example, a technology sector ETF may track an index of technology stocks. Only that, you have sector mutual funds. Number two is sector mutual funds. These mutual funds invest in a specific or a diversified portfolio of companies within a particular sector. They are actively managed and may offer more targeted strategies than sector ETFs. These mutual funds, they target a particular sector. Not only that, they provide a more active level of management compared to exchange traded funds. They are kind of passively managed. They are kind of actively managed. You have sector focused hedge funds. Sector focused hedge funds. Some hedge funds specialize in particular sectors and employ various strategies to profit from sector specific opportunities. So some hedge funds adopt this particular strategy. They are called sector focused hedge funds. They invest in specific sectors so as to be able to harness opportunities available in those sectors. Number three is common sector. We've discussed definition and purpose. We've spoken about types of sector-specific funds. We want to now talk about common sectors. That's number three. You have technology. This includes companies involved in software, hardware, IT services, and emerging technology. You equally have the healthcare sectors. This encompasses pharmaceutical, biotechnology, medical devices, and healthcare services. You equally have the energy sector. The energy sector, covers oil, natural gas, renewable energy, as well as utilities. We also want to consider financials. Financials include banks, insurance companies, asset managers, and financial service firms. You also have consumer discretionary, which comprises companies that sell non-essential goods and services, such as retail, entertainment, and travel. You equally have consumer staple. This sector focuses on companies that provide essential goods like food, beverages, and household products. You equally have utilities. These are companies. These involve companies that provide essential services such as electricity, water, and natural gas. When it comes to sector funds, they have advantages as well as disadvantages. Let's look at the advantages inherent, you know, to these sector funds. Number one is targeted exposure. Targeted exposure. So it provides investors with concentrated exposure to sectors they believe will perform well. This sector is performing well, you target that particular sector. Number three is potentials for high returns. Sector experiencing growth or favorable trends can offer high returns. Not only that, you have diversification within the sector. Sector funds typically diversify within their targeted sector, reducing company-specific risk within the sector they are targeting. If you have, let's say, 10 or 20 companies in that sectors, they can conveniently diversify within that sector. So by so doing, they end up reducing company-specific risk. I want to look at the disadvantages, the pitfalls, the drawbacks of sector funds. Number one is a sector-specific risk. Concentrated exposure can lead to a higher volatility and risk of the sector, and risk if the sector faces downturns or adverse condition. If the sector you are invested in, kind of faces sector specific risk, it will eventually impact the kind of returns you are going to get, if not outright losses. Number two is a limited diversification. Investing in a single sector limits overall portfolio diversification, which can increase risk because you are so narrowed in your investment approach. You're investing in a specific sector, then you may be exposed to sector specific risk because of what? Because of limited diversification compared to if you are diversified, across many other sectors. This is a typical risk involved in sector funds. Number three is economic sensitivity. Economic sensitivity. Some sectors are highly sensitive to economic cycles, and they're equally sensitive to interest rates as well as regulatory changes. These changes could affect certain sectors adversely. These are the risk and of course the advantages as well as the key concepts involved in sector funds.